Nigeria has been advised to borrow responsibly. This is against the backdrop of concerns about its existing debt. The advice was given during the presentation of the Global Financial Stability Report at IMF's annual meetings. Lara Folayan reports.
Presentation of the Global Financial Stability Report. Its details show concerns about external debts of emerging and frontier economies. External debt of emerging market economies have risen to 160% of exports. This is up from an average of 100% in 2008. Nigeria is particularly told to watch its debt, as though borrowing could be good for economic growth but counterproductive when negative shocks hit.
Both domestic and external debt markets are important for economic growth and economic development, and both markets should be well developed. But of course, any borrowing has to be managed in a responsible manner. There are both costs and benefits. So borrowing can be helpful for economic growth and investment, but it can also be dangerous when negative shocks hit.
Debt vulnerability in many low-income sub-Saharan economies have become predictable. The International Monetary Fund's evaluation shows more than 1,000 countries are either in debt distress or at high risk of one. It now suggests sovereign debt management practices and frameworks.
Nigeria has a large exposure to non-resident holders of domestic debt, particularly with central bank bills. And then, as we understand it, central bank bills, there's a lot of higher redemptions or higher, there has to deal with more rollovers of those in the coming quarters. And so managing those risks, particularly with respect to local currency debt and the behavior of non-resident investors, is very important.
There are recommendations here for urgent actions by policymakers to mitigate financial stability risks. This is alongside a stress test for banks and the use of prudential tools for highly leveraged firms to control corporate debt at risk, among other areas. Lara Folayan, TVC News, Washington, D.C.